Congratulations! You made your first $10,000. This is a moment worth celebrating because this is the first time you see 4 zeros in your bank account. However, if you're looking for a place to grow your money, you've come to the right place. In this video, I'm going to show you how you can invest your first $10,000 in the stock market to add a couple more zeros behind your money. Hi, my name is Kenny. I'm the lead analyst at the 5th%. Our objective is to help you grow your money safely and sustainably in the long run by investing in the stock market. So today I'm going to share with you 4 steps you can follow to invest your first $10,000. First, you need to get your finances in order, right? You have to be financially fit to invest in the stock market. This $10,000 is something that you're going to set aside and not touch for the next 10 to 20 years. And the reason why is because compounding takes time. If you were to invest this and get a 15% return for the next 20 years, the $10,000 will turn into $164,000. And secondly, you also do not want to pull your money out at the worst possible time. And most often this will be during a financial crisis, right? And the market will go down by 50%, and losing 50% is really painful. And this is the time where you need your money the most. When you lose your job, you need it for your living expenses. So there are a couple tips that you can follow to ensure that you're not in that position. Number one is to make sure that the salary that is coming in from your job, you have adequate amount of money to service all your debt. Number two is to make sure that you and your loved ones are well insured, because you know accidents do happen to us from time to time. It's good to have protection so that you will not draw on large amount of cash from your bank account. And last but not least is of course to have an emergency fund, at least 6 to 12 months worth of living expenses to see you through the hard times. So once you get your personal finances in order, this is where it helps with step number 2, which is your mindset, to control your emotions. So when things go wrong, you are more likely to hold on, because when it comes to value investing, holding power is very important. If you look at the S&P 500 chart in the history, you can see that in the long run it goes up. And one good example is if you own a very good company like Alphabet or Google, right? Even if you buy it at the worst possible time in 2008, as you look at the chart, right? Things might seem bleak in a short run, but in the long run, you benefit because this is a high quality company. They are able to grow their revenue and compound year over year. Yes, maybe your returns are not as fantastic, but you still do fine. You need to understand that stock prices do not move arbitrarily. You know, people do not understand why stock prices move up and down. In the short run, it's because of people's expectations of the company's future. But if you look in the long run, as long as a business continues to do well, make money year after year, the true value of the company or the intrinsic value of the company tends to go up over time. And in the long run, the stock prices will follow the intrinsic value of the company. And of course, at the same time, you need to have the correct mindset. When you buy a stock, you're actually buying into a partial ownership of a business. So your focus tend to shift away from just looking at the price of the stock, and you start to look towards the fundamentals of the company, whether the company is making more and more money year after year. And if you own a business and it's doing well year after year, in a financial crisis, do you sell? The answer is no, because you know that a couple years down the road, it'll be worth more. And if you just sell it when the market is good, you will make even more out of it. So you know the value, the true worth of a company. So after you have the right mindset, that's when you're able to go down and select stocks. So we have an investment process in place. As you can see from the chart, it all starts with finding an investment idea. So as consumers, we want to invest in businesses that we understand. So the best place to source for ideas is to look at things around you. Like for example, in my wallet, I have MasterCard, or maybe when you get your coffee, Starbucks, or when you surf online, Google, or when you go onto your social media, Facebook, right? These are things that you can start with. So when I say things that you can start with, doesn't mean that you should invest in that business. You still need to go through the process of researching, doing your homework to discern whether this is a good business or not. So what we have here is basically we have created the quadrant strategy. Is something that we use at the 5th%, and it's very simple actually. It all starts with business. Business is all about, for example, MasterCard. What is their business all about? A lot of people thought that MasterCard is a credit card company, but actually not. They are the network behind the credit card companies, and how they make money is simply this, right? Every time you swipe, they take a cut per transaction, and they also take a cut based on the percentage spent on the card, and it is the banks that pay them. So that's basically the business model. Once you know the business model, you also will understand the growth drivers. So for example, growth drivers will be how can they make more and more money, and what's the growth potential of this company, right? Because more and more people are going online to shop, right? E-commerce is up and coming, especially during this COVID-19 season. Everybody are moving online, so actually expedited the digitization of payment. More and more people are paying using cards, and at the same time, in physical checkout stores, people are tapping out more than using cash these days. So there's a huge growth opportunity from MasterCard. Secondly, of course, you got to look at the number. What are the numbers telling you? Are they making money or not? So if you were to look into Uber is a company that everyone loves, right? Because it's very convenient. You just book a cab on your phone and just write it out, and people love it. But doesn't mean it is a good business. If you look closely at the numbers, they are losing money year after year, and they're listed in the stock market. We are basically VC funding them to run their business. But when it comes to MasterCard, you can see that they are making a strong recurring revenue year over year. They don't require much capital to run the business. So this is the kind of solid business that we want to invest in. And of course, the most important thing is the person running the business. Do you trust the person running the business? Imagine you own the business 100% out straight, and you hire a management. You want someone who's honest, capable, who's aligned with you, and they have a fair compensation package for them, right? You don't want them to take a huge chunk out of your business for doing nothing at all. And last but not least is valuation. Valuation is something that determines your return in the long run. So if you buy at a high valuation, you get poor returns over the long run, even below market returns, where you can just simply invest in an ETF and do better than invest in the stocks. So when it doesn't meet your valuation, that's where we push it on to our watch list, right? We want to be there when the prices come down. So once you build a watch list and set the target prices that we want to go in when those prices hit our targets. And then at the same time, we also have to monitor our stocks. It's not a hands-off approach. Once you invest, you can just go to the beach and chill. But instead, you got to monitor them, read their quarterly reports, keep up with the news to know if there's anything that will go wrong, right? For example, MasterCard, if there's another Alipay or WeChat where they bypass the network, that is something that we want to know early and exit when that happens, right? We don't sell because the stock price go down. We sell because there's a long-term structural change that will affect the value of the business in the long run. So that's simply the process, stock selection process that you should follow. If you're interested to find out more about the quadrant strategy, you can go to www.quadrantstrategy.com, or you can check out the link in the description box down below. Step number 4, portfolio allocation. This is where or how you should manage your risk, right? Ideally, you want to have 10 stocks in your portfolio. You're distributed equally, each one 10% of your capital that you put in the market. But since you have only $10,000, and if you want to invest in high quality companies that are priced above $1,000, there are limited choices that you can make. Now, I want to show you this portfolio that I built, which comprised of Amazon, MasterCard, Alphabet, and Facebook. As you can see, I wanted to have 4 different positions. Ideally, I want to split them 25% each way, but it's not possible and it will never be perfect. But as I get more and more money, that's where I start to add on more capital or build new positions. So for example, if I have Amazon 2,500, Facebook 2,500, and if I get my hands on another 2,500 worth of capital, that's where I will start to look for a new company to invest my money in. So from then on, I'll have 5 positions, 6 positions, and eventually 10. And the idea here is not to go crazy. It doesn't mean that the more you diversify, the better you'll be. But you need to understand also that good companies are hard to come by at a good value. So at most in a year, I only invest in 1 or 2 ideas that are undervalued, unless when there's a crisis. So that's where a lot of companies are up for grabs. That's it for me. I hope you enjoyed the video. And if you find this informative, share it with your friends. And remember to hit the like and subscribe button if you want to see more of these contents below, so whenever we release new videos, you're able to be notified of it. And at the same time, if you have any questions, feel free to leave questions down in the comment box and I'll be there to answer them. So thank you very much, and I'll see you in the future videos.